Yes, people, a very, very happy afternoon to all of you. Thank you so much. Lakshita wants to remind Teresa, it's not morning, it's afternoon. Be careful. Huh? Oh my God. It's entire consolidation. If I get answer from there, nicely I can teach. So, yes, people, we're starting yet again a brand new topic, one of the deadliest topic, one of the most challenging topic according to people, but not so challenging, right? That's one and only accounting for consolidation of financial statement. Not accounting, it's consolidation of the financial statement. Consolidation of financial statement. This is chapter 10, unit 1 of your ICA module. Let's have a discussion on the applicability of this AS. AS 21. This particular chapter is being governed by Accounting Standard 21. This particular chapter is being governed by Accounting Standard 21. AS 21 is a mandatory accounting standard applicable on all the entities, whether companies or non-companies. You can't stop here. Very important point. If such entities are required to present the consolidated financial statement, if any entity is required to prepare the consolidated financial statement, for them it is mandatory to follow AS 21. AS 21, recollect people, we studied applicability of accounting standard for corporates and non-corporates. What did we study there? It is event-based exemption. We have event-based exemption. Means what? If consolidation is applicable, you have to follow AS 21. Otherwise, not required. Otherwise, not required. Let me again continue, people. Legal requirement of preparing the consolidated financial statement. If you are thinking that AS 21 mandates you to prepare consolidated financial statement, then my dear friends, you're wrong. The requirement to prepare the consolidated financial statement is being given by Companies Act 2013. Section 129, subsection 3 of the Companies Act 2013 mandates to prepare the consolidated financial statement of the company. So can we go to section 129? Section 129. Okay, not okay. Which talks about the financial statement. In that, subsection 1, subsection 2, and subsection 3. I'll little bit zoom it out. Is it readable? Or I'll read like this. Where a company has, this line is focusing about companies, means corporates. Where a company has one or more subsidiaries or associate company, it shall, which means company shall, which company? Company is got subsidiary now. Who am I? Holding company. So if holding company has got any subsidiary or associate, it means that holding company, that parent company, in addition to financial statement, means apart from the normal financial statement that you prepare, under subsection 2, you prepare the normal financial statement. Apart from that, you're also supposed to prepare a consolidated financial statement of the company and of all the subsidiaries and associate companies in the form and manner as that of its own and in accordance with applicable accounting standards, which shall be laid down before the annual general meeting of the company along with laying its financial statement under subsection 2. So this section is saying that it's not saying, it is ordering you. It is ordering you, telling that if you are a holding company and if you have a subsidiary company or associate, you will prepare as per subsection 2 standalone financial statement. So I'm holding company. CA.Prathik Academy Limited is a holding company. I will prepare my financial statement separately only for CA.Prathik. That is called as standalone financial statement. Let's suppose I have a subsidiary, Fortunes Fund Learning Academy. I have another subsidiary called as SPJ Academy. For that also individually I'll prepare financial statement. KVA Limited, FFLA Limited and SPJ Limited, SPJ Academy Limited. This is holding company and these two are subsidiary company. For convenience, I take only one subsidiary. You will prepare separate financial statement for KVA and separate financial statement for FFLA. Preparing of such financial statement is called as standalone financial statement. Standalone financial statement means what? Individual financial statement. So you have to prepare standalone financial statement. Standalone financial statement. Apart from that, holding company is supposed to prepare a consolidated financial statement where the financial statement of KVA and the financial statement of FFLA is combined together and named as consolidated financial statement. So in what manner you prepared this? In the same manner, you're supposed to prepare the consolidated financial statement. Both of these has to be incorporated in the annual report and should be submitted to the shareholders before you invite them for the annual general meeting. All of you know that once in a year, you have to carry out a meeting called as annual general meeting. In law, you have studied what is the maximum date, last date, by when you're supposed to carry your AGM. In law, you have studied 6 months from the end of the financial year, you're supposed to have your, which is 30 September. 30 September is the maximum date by when you're supposed to have your annual general meeting. Before that, you're supposed to give, that is there, normally I'm talking about. You're supposed to give invitation. You're supposed to give invitation to whom? Shareholders. So when you invite them, along with it, you're supposed to send the annual report. So annual report will comprise of what? No. Come from order. There will be a lot of things. Primary things is director's report, auditor's report, financial statement. Which financial statement? Standalone financial statement. Then consolidated financial statement. All this will be there in your annual report. Got it? Not got it? So who compels you? Who compels you? Who mandates you to prepare the consolidated financial statement? It is company law. It's company law. In section 129, subsection 3, which mandates you, which makes a compulsion on you to prepare the consolidated financial statement in such a form and manner and with applicable accounting standards. With applicable accounting standard. Which applicable accounting standard is here? AS 21. So section 129, subsection 3 forces you to prepare the consolidated financial statement, and how to prepare that guidance is being given by whom? Accounting Standard 21. So AS 21 is just guiding you how to prepare the consolidated financial statement. It is not compelling you. AS 21 does not mandate you to prepare the CFS. CFS has been compelled to be prepared by whom? Companies Act 2013. Under which section? Section 129, subsection 3. Any difficulty? Online people, any difficulty? Online people, any difficulty?
No, sir.
Am I audible to all of you?
Yes, sir.
Okay, now section 129 subsection 3 of the Companies Act 2013 mandates to prepare the consolidated financial statement of the company. Now coming back, section 129 subsection 3 compels to prepare CFS for whom? For companies. Look at the language. Where a company has one or more subsidiaries or associate, it shall, in addition to normal financial statement, prepare the consolidated financial statement. So which means so far, does any other law mandates you to prepare the CFS for the non-corporates? No. So for non-corporates, as of now, as of today, consolidation not required. But if it is applicable up till now, then you have to prepare the CFS. That's why we gave event-based exemption. If any law says or if any standard says to apply up till now, then apply. Otherwise, not compulsory. Since we put AS 21 under event-based exemption. If event is there, then prepare it. Otherwise, not required. If there is any compulsion to prepare CFS, prepare it. Otherwise, not required. Okay, not okay. So as on today, for non-corporates, there is no applicability of AS 21. So for whom it is applicable? For corporates. Which corporates? Who are having either subsidiary or associate, they have to prepare the consolidated financial statement. Okay, not okay. So if I am a company, I don't have any subsidiary or any associate. Will I prepare CFS? Not required. Got it, not got it. So though I said AS 21 is mandatory, look at my language. I use the word mandatory. Why? Because if it is applicable, you have to follow AS 21. That's why I would use the word mandatory. If it is not applicable, don't prepare. Now, are we clear with this point? Yes or no? I want loud, yes. Energyful, I want. Now, sir, what is the objective of this AS 21? The objective of this standard is to set out what? Principles and procedures. Principle means what? Rules. Procedures means what? Step-by-step process of how to prepare and present the CFS. So AS21 is going to guide you, like how I'm guiding all of you. AS21 will guide you how to prepare and present the CFS. How should I prepare the CFS? How should I present the CFS? For that, we need what? Rules and step-by-step procedure. That is what has been laid down in AS21. So AS21 is going to guide you or set out the principles and the procedures that is required to prepare and present the CFS. So how many P? Principle ka P, procedure ka P, preparation ka P, presentation ka P. So what is the objective of this accounting standard? The objective of this accounting standard is to set aside or set out principles and procedures for preparation and presentation. First you prepare, then you present. Preparation and presentation of the consolidated financial statement. Any difficulty? Consolidated financial statement is presented by whom? Parent company or subsidiary company or both? Only parent company. Only one of you have to show the consolidated financial statement. Not everybody. Doesn't make sense, no? Because when you merge both, the data is one. Whether I show it or subsidiary show it doesn't matter, no? But law said that this is to be presented by whom? Holding company, also called as parent company. So this CFS is being prepared and presented by parent company, was also called as holding enterprise, to provide the financial information about the economic activity of its group. Now, what is the meaning of group? Tata, how many companies they have? Can you name few Tata companies? Tata Steel Limited. Tata Motors Passenger Vehicle, the company is split now. Tata Motors Passenger Vehicle Limited. Then we have Tata Motors Commercial Vehicles. Then TCS, Tata Consultancy, very good. So all these are multiple companies, n number of companies. It's not one or two companies. The list of the companies going for 2 pages. Our balance sheet goes for 2 pages, no? For them, company ka list alone goes for 2 pages. All the company put together are called as group company. Tata's group concerns. All these are called as group. Group means what? In the group, I have multiple companies. So SPJ is a group. In that I have Kalpavich. In that I have FFLA. In that I have SPJ Academy. So all under one roof. So SPJ is what group? SPJ is what group? So here, why are we preparing CFS? We want the economic activity of entire group to be shown in one place. You have standalone financial statement, which is giving you information about that individual company. I want to know on the whole, how is the group performing? And that view I'll get from CFS. That perspective I'll get from CFS. These statements are intended to present financial information about a parent and its subsidiary or subsidiaries in a single economic entity. So here, when I prepare the financial statement for KVA, I will get only economic activity ka information of KVA separately. And I'll get information about FFLA separately. Now, I am a shareholder who's holding both the companies. I have investment in both the companies. So I want to know combiningly, how does my result look like? How does my P&L look like? How does my balance sheet look like? Got it, not got it. About this, I want to say a lot, but I will not say too much and bore you today. Today, I want to start a little bit of practical. Once we do practical, once you understand how the entire masala, is being blended and nicely presented, once you taste the masala, come back at the end, read the theory. Each and every point will make sense. So after today, last class, I will discuss why do we do consolidation? What is the benefit of consolidation? When I do at the last class, no, by the time you have done consolidation, you know how to prepare consolidation. You know the crux of it. You know the emotion of it. You know the feeling of it. When I come back and read each and every point, no, you'll be able to practically feel it. If I read it now, you will read it, you'll understand by English language, but nothing will go to your heart and mind and your soul. So today I'm going to take limited theory. Masala theory, I'll take it at the last class. Okay, not okay. I'm keeping my limited theory today. These CFS are intended to present the financial information about a parent company, holding company, and subsidiaries as a single entity. The financial data which is scattered in multiple companies, in multiple balance sheet, multiple P&L, we are combining everything and putting in one single P&L. Turnover of KVA, let's suppose 10 crore. Turnover of FFLA, 20 crore. Individual, okay. I want to know total how much. So in CFS, I have 30 crore. This is a different feeling. Husband earns, wife earns. Separate maza. Combining, if I say, oh my God, he earns so much. Then, oh my God, feeling we want no. For that, people do CFS. This is one way of telling. But there's more information to it, which I'll discuss in the last class. To show the economic resources controlled by the group, the obligation of the group and results of the group achieved with its resources. This part I'm not going too much in detail because too much of theory I feel people will get bored. And seeing you bored, I'll also feel bored. Boring, cancel. So we'll go for practical questions. But little bit of theory is required. A little bit will do. Explanation for the above paragraph. AS 21 outlines, gives you an outline of principle. What does principle says? AS 21 will set out the rules that you have to follow. In preparing CFS, there are certain rules that you have to follow. That is called as principles. AS 21 gives you procedure also, step by step how and what you're supposed to prepare. How AOP has to be prepared. How you're supposed to calculate the minority interest. What is the reason for calculating goodwill and capital reserve? What is the reason for preparing consolidated reserves and surplus? Like that, lot of things we are supposed to prepare. So that step-by-step procedure has been outlined here. Any problem here? No problem. AS 21 outlines the principles and procedures for presentation and preparation of the consolidated financial statement. Means what? How the consolidated financial statement are made and shown in the entire group taken together. Separately or prepared. No, combiningly. When I combine, how the result looks like. You think it will be easy. Sir, 1 plus 1 is 2. No, sir. 1 plus 1 is 2. It's not that easy, my dear friends. Turnover of FFLA, if I merge with turnover of KVA, total turnover 30 crore. I'm so sorry. You can't add it that easily. Actually, we're going to do this only. But with this, a lot of masalas will come. Those masalas, one by one, we have to remove. When you eat a gravy, in that, if that ilaichi, what do we say in English? A cardamom. You eat nice paneer butter masala. Ilaichi, that cardamom comes inside your mouth. How do you feel? Biryani? Okay, biryani. No, I explain much in gravy, so I say give gravy, but biryani also I'll give. Biryani. You have biryani. You get cardamom in your mouth. How do you feel? How do you feel? Yeah, the same expression. Now, when you add these both, you will get some cardamoms that you have to eliminate. Elimination of that is painful activity. That is where people get confused. You will not believe that people know how to do elimination. Logic of the elimination people don't. Today is my open challenge, and at the same time promise that each and every point that we do, what is the logical reason behind it, I will update you in such a way that the amount of knowledge that you'll carry at the end of this chapter will be enormous and much more than any of your friends who have not studied this topic in that way. You can go and cross test your friends also. Now, AS 21 outlines principles and procedures for preparation and presentation of the CFS presented by parent company. So who should prepare the CFS? Parent company, which is also called as holding company, prepared by the holding company to provide financial information, which is giving useful and reliable financial data to the users of financial statement. About what? About economic activity of the group. Means about the business operation on the whole group. What is my total profit? What is my total revenue? What is my total expenses? What is my total tax? What is my total asset? What is my total liability? So you get the group on the whole. Group on the whole, you get the information. So nothing but whatever I wrote in the above paragraph from people, that I broke it point wise. So each point is saying what is what I've explained. If you observe it very carefully, what is the meaning of principle I've given here? What is the meaning of procedure I've given here? What is the meaning of preparation and presentation of the CFS? I give the meaning here. So arrow mark is there in between. After arrow mark, I've explained what that means. Okay, not okay. Again, still I was not satisfied. So I said in simple words, AS 21. AS 21 does not mandate, rather provides guidance on how to prepare, present, and disclose the CFS by the parent company. In one line, I gave the answer also. Who mandates preparation of CFS? Companies Act 2013. Which section? Section 129, subsection 3. Very good. And who should prepare the CFS? Which holding company or parent company has to prepare, not subsidiary company. Okay. Now, chalo, we'll discuss this point and then I'll go to question. Control. Somewhere we have studied this control. Related party transaction. Very good. So tell me, people. As per AS 18, there are three conditions laid down to check whether you have a control or not. What is the first condition? More than 50% voting power or voting right or condition. Very good. Power to compose. Power to compose means what? You have a power to appoint a director or remove the directors from the board of directors. Board of directors are the governing body of any organization. They make the decision in the organization. That decision making authority, you're having the power to compose or recompose them. Hey, you get out of this board of directors meeting. You are no longer the director of this company. Hey, you come inside and sit. Like that, you are having the authority. You are having power to compose, which means you have a control on that company. You have a control on the company. Or substantial interest plus power to direct. All this where did we study? Accounting standard 18. So without AS 18, can you manage? You can manage, but little bit difficult. Substantial interest means what? Voting right 20% or more. Power to direct means what? Power to direct. Power to participate is substantial interest. Sorry, power to participate is significant influence. The significant influence. Tell me. Power to direct means what? Operational. Sorry, I didn't listen. Operational policy, financial policies. You can direct what should be there as a part of operational policy, what should be there as a financial policy. You have power to direct that. What to do, what not to do, how to do, all that you have to discuss. So if these three things are there, out of these three, if any one is there, means you're having the control over the company. Now, listen. Very important. For the applicability of AS 18, out of these three, if any one is applicable, you are having a control. If you're having a control, means you're a related party. And as per AS 18, you have to give disclosures. But when you check the applicability for AS 21, the last condition is not applicable. Last condition is not applicable. Only the first two conditions are applicable. If I am a company, Kalpavriksha Academy is got 51% stake in FFLA. So between Kalpavriksha Academy and FFLA, there is a relation of holding and subsidiary. Then AS 21 is applicable for you. Got it? Not got it? Or power to compose. FFLA is board of directors. Who's controlling? I am controlling. From Kalpavriksha Academy, I am controlling the board of directors of FFLA. So if out of these two conditions, if any one is satisfied, AS 21 will come into picture, holding subsidiary will come into picture. Third condition is not applicable for AS 21. Okay, not okay. Anand people, okay, not okay. FFLA, this is KVA. KVA is invested 21% in FFLA. Plus I have power to direct. No power to compose, power to direct. Yes, KVA and FFLA holding subsidiary. What, yeah? More than 20%, yeah? Oh my God. More than 20%. 20% or more will give you substantial interest. Power to direct will give what you called power to direct. Thank you so much. This does not create a holding and subsidiary relationship. For you to have, I'm coming. Holding subsidiary. Holding subsidiary. Holding subsidiary. Are they holding subsidiary? No. Are they having control? No. Associate will be covered in AS 23. Consolidation of associate is covered in AS 23. We're talking about AS 21. In AS 21 people, it is consolidation of the subsidiary. So here when I'm talking about control means I'm talking about holding and subsidiary. Okay, not okay. Online people, okay, not okay. When one party has more than 50% of the voting right, there is ownership of another party. Party here means what? Company. Either directly or indirectly with one or more subsidiary. Or when one party has power to compose the governing body of another enterprise, then we say that the company which is having the control over the other company is the holding company, and the other company which is having the control is called as subsidiary company. Okay, not okay. Power to compose means power to appoint or remove all or the majority of the directors of the subsidiary company. Either all or majority. All of them you can remove, or majority of them you can remove or appoint, whatever you say. This is control. AS 21 talks about Consolidation of the financial statement of holding and subsidiary. AS23 talks about associate and AS27 talks about joint venture transactions. Okay, not okay. So here the focus is only and only on holding and subsidiary. Holding and subsidiary. For you to become holding subsidiary, out of these two, any one condition has to be satisfied. When it is satisfied, you say you have control, and when you have control means you are holding an other company is automatically subsidiary company. Any difficulty? Online people. Little bit motivation, online people.
Yes, sir.
Okay. Others are not responding. It's okay, no problem. Now, not today, I would say next 3 classes, the major emphasis will be on focusing on the basics. We are going to do a lot of examples, small bits and parts. Once you understand how the examples are being done, once you understand these examples, doing big questions will not be a problem. A lot of places, people take the first question, they start working out the CFS. That will not help you. To reach a full-fledged CFS will take at least 3 to 4 classes. So 3 to 4 classes, let's say around 6 to 8 hours, we're only going to work on basics. Only fundamental questions. The moment you get a hold on it, it's my open promise that we'll have no difficulty in CFS. It's my open challenge. Are you all ready? Yes. Now, example 1, calculation of simple CFS. I'm going to do 3 examples to make you understand how the consolidation of the financial statement works at the broader level. Second, generally when you merge these both financial statement, subsidiary ka capital does not come into the balance sheet of holding company. When I ask people why the capital of subsidiary does not come into holding, I'm not saying everybody, but majority of the people, they say we don't know. So the intention behind these 3 examples is to purely put a concept in your head that why subsidiary ka capital upon merging, it does not come into the holding company. So for that 3 examples, are you all ready? Now, if you look at this, balance sheet of H Limited, H stands for holding. For convenience, I have taken H and S. H stands for holding, S stands for subsidiary. Share capital of holding company 3 lakh and 2 lakh of S Limited, that is subsidiary. Current liability of holding company is 7 lakh and for subsidiary it is 1 lakh. So 3 plus 7, 10, 2 plus 1, 3. Total matching, not matching. Lakshita, matching, not matching. Very good. Investment. 100% investment in S Limited. So H Limited has invested 2 lakh rupees in S Limited. Holding company has invested 2 lakh in S Limited. What is the capital of S Limited? 2 lakh. Who gave that money? Holding company. Full. What is this called as? What is the relation between H and S? Holding subsidiary. But what it is specifically? Wholly owned subsidiary. Wholly owned subsidiary. When 100% of the capital of S is coming from holding means, then this S becomes wholly owned subsidiary. Wholly owned subsidiary. Okay, not okay. If you come to your AS people, page number 10.7, if I'm not wrong. Yes. Here they're given the difference between wholly owned subsidiary and partly owned subsidiary. What is wholly owned subsidiary? A wholly owned subsidiary company is one in which all the share are owned by the holding company. Please tell me, what is the share capital of subsidiary company? 2 lakh. This 2 lakh capital, who gave you? Holding company. 100% money has come from the holding company. So for holding company, that subsidiary is called as wholly owned subsidiary company. Means entire company, I own it. Kalpavriksha Academy has got 100% stake in FFLA. So for me, FFLA is my wholly owned subsidiary. I own the entire subsidiary. Nobody else owns it. I am the sole owner. I means what? This holding company is the sole owner. There is no other part owners. 100% voting right are vested by the holding company. There is no minority interest. Now, what is the meaning of minority interest? Forget that. If holding company is holding any share, if holding company is owning any share, we call them as majority interest. This should be minimum what? Minimum what? 50 point, above 50%. Above 50%. Preferably 50.5 and above. Preferably 50.6. Up the holding subsidy will come. For you to become holding subsidiary, what is required? Voting right should be more than 50%, more than 50%. So here always the holding company will have majority share, more than 50%. Any problem? So for convenience, I'm putting 51%. Do you have any problem? Remaining is how much, people? Remaining is how much? 49%. These are called as other shareholders, other shareholders. And we in consolidation called as minority interest, minority interest. Got it? Not got it? If you think those shareholders which has got less holding, they are minority company, now you're wrong. Today itself I'll prove in one place that what you're thinking is wrong. What are you thinking? Out of 100, which is bigger? 51 is bigger. Oh, upper that is majority. 49 is small, minority. No. The word majority and the minority has got its own significance, which I will explain you when the right time comes. Okay, today itself we'll discuss. Today itself we'll discuss. So majority does not mean 51%. Minority here does not mean 49%. Today itself I'll prove this point. But all we're trying to put forth here is that holding company will always hold the major share. If holding company is investing shares in the other company, holding company will have more than 50%, more than 50% stake. Got it? You guys are giving little bit dull face. I'll give an explanation here. No problem. No, you didn't get it. Now, tell me, Purvi, how does the control come? How does the control come? Two ways. Either you are having investment more than 50% in the subsidiary company, or power to compose. Holding company did not invest even one rupee in the subsidiary company. Holding company did not invest even 1 rupee in the subsidiary company. But holding company has got power to compose. So my question to all of you, the share capital of holding company, sorry, subsidiary company is 2 lakh. Who is owning this shares? Others. 100% shares are held by others. Apana, there is no majority with holding company. So who is major here? Others are major, but still we call them as minority. We call this minority. Got it? Not got it? Now, what is the difference? I'll tell you. Majority here means who has got the control. The person who's got the control, we say majority. The person who does not have control, we call them as minority. No control is called as minority. So majority, minority, don't go with the percentage. Oh, 51%, more percentage, majority, 49%, less percentage, minority. Don't go with the percentage. Go with the control. See, in our second example, holding company has not invested even 1 rupee in the subsidiary company. So holding company is not having any investment in the subsidiary company. So 100% capital belongs to others. 100% capital belongs to others. But holding company has got power to compose. So control is there with the holding company. So holding company will be called as majority. Others will be still called as minority. Others with 100% stake also still called as minority. Okay, not okay. There is no minority. Minority here means what? Other shareholder. There are no other shareholder. In the wholly owned subsidiary, there is no other shareholders. Other shareholders in consolidation are referred as minority interest. In consolidation, wherever minority interest comes, it means other shareholders. One second, I'll just finish this part. Because all the shares with the voting right are held by the holding company. So if 100% voting right is there with the holding company, we say that subsidiary is the wholly owned subsidiary company of that holding company. Partly owned subsidiary company means what? If in a partly owned subsidiary, all the shares of the subsidiary company are not acquired by the holding company, that is only majority of the shares are acquired, which is more than 50%. So 51% with the holding company, 49% with the others. Voting right of more than 50%, but less than 100% are vested in the holding company. Hence, this is called as partly owned subsidiary company. So how much do I own it? 51%. I own how much of FFLA? Since I invested or contributed to 51% of capital, I will say I am 51% owner of that company. So I am partly holding the company, not fully. There is a minority interest. Minority means what? Other shareholders, because less than 50% shares with voting rights are held by outsiders, that is others other than the holding company. So in our example, 49% of the stake is held by others, and those are called as other shareholders, also called as minority interest. Now listen to me very carefully. Another name for minority interest is non-controlling interest. What is the name? Non-controlling interest. This name is not given in accounting standard. This is given in Ind AS, which you study in CA final. This topic has got a continuation in the CA final. And there, they've not used the word minority interest, they've used the non-controlling interest. What interest? Non-controlling interest. So here, in the inter-level, they should use the word only minority interest. But by chance, if they use the word non-controlling interest, please understand they're talking about minority interest only. But in final, the word will not be minority interest, it will be non-controlling interest. Where it is? Int AS. Now, let's come back to our original question. Yes, boss. हाँ, other eight possible because for a company to form private, minimum 2 promoters has to be there. For public, minimum 7 should be there. But both are others, no? They're not belonging to holding company. Rethink it out again one more time. Now, come back. हाँ, okay. Subsidiary company, share capital, 2 lakh. This is held by whom, you know? X is holding, let's say, 1,20,000 ka capital. X gave 120 capital. Y gave 80,000 capital. Both are other category. Why? Because X and Y has got no connection with holding company. But when this company was formed, there's an agreement between the holding company and the subsidiary company that X and Y will not make that, though they'll make the decisions, but in consultation with the holding company. If X is not performing the activity as per holding company's advice, I have the power to remove him from the board of directors. I'm not removing from the company, but I'm removing him from the board of directors. In place of that, I'll put some other person as director, and it is not necessary that directors should be the shareholders. Directors are those people who are the decision making in the company, who are taking the decisions in the company. Which means whatever decision is being taken by the subsidiary company, if it is influenced by holding company, even though holding company does not have any stake, still they're influencing company. Then holding company has got the control. The kudumi of the subsidiary company is with whom? Holding company. Got it? Not got it. Even though the 100% capital belongs to other category, and these others will still be referred as minority interest. Why? Because they don't have any control. There's no control. So they have non-controlling interest because the entire control lies with holding company. Now clear? Then if holding company is not there, nobody is there to control, the relationship is not coming, then there's no point. No, why I said that point? Because he said if a company has got only one person holding all the shares, I said it's not possible because there should be minimum 2 promoters to start a company. That's what he studied in the basic 12th. So that's what I answered that you should have minimum 2 promoters who should have capital. One person having the entire capital is not possible in case of private company. In public, you should have minimum 7 people holding the capital. Got it? Directors can be different. Directors are different. Promoters are different. Promoters and capital are linked to each other. Directors need not have the shares. Correct. That's not the Companies Act law will not allow, no. Anyways, you're still very weak in law, madam. Foundation office karata hu main ek baar. Now come back. Okay, come back. Current asset of holding company is 8 lakh and subsidies 3 lakh. Any difficulty, people? Observe the balance sheet. Do you find any flaw? Any flaw? I've kept a simple balance sheet. In this, masala will come. Reserves and surplus will come. This will come. That will come. Nothing I've put. I've kept it very, very simple. Now, what is the requirement? H Limited acquired shares of S Limited on 1/4/24. I've given the balance sheet of 31st March 25. I've given the balance sheet as at the end of the year. In the beginning of the year, 1/4/24, H Limited acquired the shares of S Limited and made the company wholly owned subsidiary. Listen, you are supposed to prepare the consolidated financial statement. You're supposed to prepare the consolidated financial statement. There's one point that I have discussed, which I'll discuss after some time, not now. On 1/4/24, holding company is buying shares of S Limited. Does it mean that S got incorporated only on 1/4/24 or was S there even before also? Now listen to
Was
very
there
carefully.
before also.
Yes, you're right. KVA. KVA will first issue the shares to whom? The two promoters you have started the company. Let's say KVA Private Limited. So two promoters. Let's say one is SPJ, one is AJ. We started 51% stake with SPJ, 49% stake with AJ. Two people. Now, these two are individual people. These two are individual people. Now, let me put it not SPJ, I'll make it FFLA. Now, Kalpavriksha Academy has got an eye on FFLA. Why? Because FFLA is handling 11th and 12th people. So, Kalpavriksha wants to acquire the shares of majority shares of FFLA. So, now KBA has approached the two promoters telling that we want to invest in your company. We want to invest in your company. Got it? SPJ gave 30% stake to KVA. SPJ gave 30% stake to KVA and AJ has given 21% stake to KVA. Both put together how much people? 51% stake is gone to KVA. How much is left with SPJ and AJ? 21 percentage and 49 minus 21. How much it is? 28 percentage. Correct? So now, how many shareholders in total? Three shareholders. SPJ with 21 percentage, AJ with 28 percentage, KVA with 51%. Listen to very carefully. This FFLA company got incorporated some 3-4 years ago. When the company was incorporated, FFLA gave shares to SPJ, SPJ gave money to FFLA. Yes or no? This is called as issue of share. When the company is issuing the shares for the first time, we call that as fresh issue of shares, where the company will receive the money and the shares are directly allocated to the person who's giving the money. Yes or no? Yes. Same way, AJ also gave money, capital, directly to the company, and company allocated the shares directly to AJ. This is the first step. This is the first step. After a few years, 2-3 years later, Kalpavriksha Academy wants to buy this company. 51% stake they want to buy. Now, please tell me, 51% stake if KVA is taking, will it take free of cost? No, they'll pay paisa. KVA will pay this paisa to whom? Company or to the shareholder directly? It'll go to shareholder only. Once the company issues the share, subsequent transfer of shares will not affect the share capital of the company. Shareholders register will keep on updating. For example, today I have purchased Reliance ka share. Yesterday somebody else was shareholder. Today I am the shareholder. Day after tomorrow somebody else will be the shareholder. So between us, the shares will be keep on rotating. So for this, will you disturb the company? Hey company, take capital. Hey company, give capital. Hey company, take capital, give capital. The company will polipili. So once the shares are issued by the company, and subsequently when the share transfer takes place in the stock market, the money rotates between the shareholders. If I sell the share to you, I'll give the shares to you, I'll take money from you. You will give the shares to somebody else. So the money and the shares is rotating between us. What will company do? Company will make a note. Okay, today who is holding the share? Their name they'll record in the shareholder register. Tomorrow who is having that share? His name will be written. The old name will be stricken off and a new name they will record. This is what company does. So company's bank account, company share capital will not get affected on everyday basis. Got it, not got it. So subsequent shares that you sell, no, that keeps on rotating between us. In between, who is helping us? Stock brokers, stock exchange. These people will help us facilitate the transfer of shares. Without stock exchange, you can't transfer the shares. Without stock brokers, you can't transfer the share. So these two intermediaries are helping us to transfer the share smoothly. But in this entire process, company is not getting affected. The company's day-to-day working is not getting affected. Got it, not got it. So here KVA paid money. KVA paid money to SPJ. SPJ gave shares to KVA. KVA paid money to AJ. AJ gave the shares to KVA. Got it, not got it. This is how it functions. So now here, when I said on 1/4/24, they acquired. I didn't say issued the share. What is the language? Acquired the share. So Heads Limited acquired the share from whom? Existing shareholders of S Limited. From the existing shareholders of S Limited, we acquired. The language acquired is very important. You need to understand whether the company is issuing the share or acquiring the share. Subsidiary is issuing the share அப்படின்னா அது வேற விஷயம். If H is acquiring share means it is different. Both are different. Got it, not got it. So here H is acquiring or H is getting shares allotted. H is buying from the existing shareholder or are they getting it issued from the company? They're buying from the existing shareholder. Got it, not got it. Okay. Now, they're asking us to prepare the consolidated financial statement. That too only balance sheet. I don't have P&L now. I'm only teaching the balance sheet part. Only both of these companies, if you add, H plus S becomes consolidated financial statement. Both of this, if you add, both of this you add, what do you get? 5 lakh, 8 lakh, 2 lakh, and 11 lakh. This is consolidated financial statement. That's all. But it is not that easy as you're thinking. In this balance sheet, there's some drama. There are certain intercompany transactions which has to be eliminated. If you don't eliminate it, it will not be a proper balance sheet or proper P&L. So all the intercompany transactions are eliminated. So eliminating them is the biggest problem in this chapter. Okay, not okay. Now tell me people, can I just take a paper pencil, add and just leave it? Consolidation. Can I do it on Excel sheet and say this is add both and say this is the financial statement? Yes. If you are thinking that I'm going to pass journal entry for all this, my dear friends, you're wrong. Consolidation is not being done in your books of accounts. You will not touch your books of accounts. This is done on a separate piece of paper, or rather we'll say Excel sheet, or a separate software has been used to merge both the data. We will not do any journal entries. We will not pass any treatment in the books of accounts. You will not touch the books of accounts. This consolidation is done only for our comfortability. There's a purpose, objective behind it, which I have not discussed in detail though. I'll discuss in the last class. There's an objective of this. And for achieving this objective, we will not disturb the regular accounts. To achieve this objective, we should not disturb the regular accounts. But since you understand debit credit more better than Excel sheet, so what I did is for you, I'm going to teach journal entry. I'm going to teach journal entry. Now tell me people, holding company, holding company, holding company. I want to incorporate their capital into my capital. I want to incorporate their liability into my liability. I want to incorporate their asset into my asset. You tell me people, what entry will I pass? I'm holding company. Let's suppose I'm passing entry. I'm giving a disclaimer. In the entire consolidation, never, ever, anywhere, we will do journal entry. This journal entry is only for your educational purpose, only for your better understanding. We will not do journal entry. Got it, not got it? Okay. Now, holding company wants to combine the capital, asset, liability of the subsidiary company in our book. What entry should they pass? Share capital, liability of that company now becomes liability of my company also. To create liability, I have to give a credit. All the liabilities credit, all the assets debit. Tell me the entry. Very good. Current assets account debit to share capital to current liability. Everything you take. Later I'll tell you how you have to eliminate it. Tell me the amount people. Current liability is, sorry, current asset is 3 lakh. Then 2 lakh, 1 lakh. Okay. 3 lakh, 2 lakh, 1 lakh. Any problem? Now tell me after this entry, how will the balance sheet of holding company be? For convenience, can I do T-shaped format of balance sheet? For convenience. You're not allowed to do the T-shaped format, but for convenience, I'm doing it. After this entry, people, let's see how the balance sheet looks like. Share capital. How much is the existing share capital already of the holding company? Holding company ka capital is 3 lakh rupees. Plus, you gave another credit of 2 lakh rupees. Credit will increase your liability further. So plus 2 lakh. Total is how much people? 5 lakh rupees. Online people, do you have any difficulty in this? Online is very sad today. Nobody is responding. Anyways. Now, next is what people? Current liability. Current liability. What is the current liability already of the holding company? 7 lakh rupees. You again give a further credit of this 1 lakh. Credit will increase your liability again. plus 1 lakh. How much it is? 8 lakhs. Can you do CFS in the T-shape format? Schedule 3 said that you have to do the vertical format, but I'm doing in T-shape format only for your understanding. So this is consolidated balance sheet. How much is the current asset, people? Holding company is already having the current asset of 2 lakh and 8 lakh. 8 lakh will put. How much is the current asset of subsidiary? 3 lakh. You're given a debit of 3 lakh. Debit will increase your asset by 3 lakh. So plus 3 lakh. What is my total current asset? 11 lakh. Investment. Investment of holding is 2 lakh. Do we have any investment of subsidiary? No, zero. 2 lakh rupees. Can you please add and tell me the total, please? 13 lakh, 13 lakh. That's all, people. This is consolidation. Adding of two or more balance sheet together, adding of two or more P&L in the holding company together, this is consolidation. All around. For this, so much drama, consolidation, so much stuff. Very difficult. It is difficult. Here, there are certain transactions which we have to adjust for. Adjusting that is a pain. Now that Piyush has done this topic already, consolidation. Yes? Make it. What is wrong here, Piyush? What is wrong here? Okay, leave Piyush. Everybody, you say, what is wrong here? This balance sheet, something is wrong. Very good. Now, imagine holding company, Anita ma'am, subsidiary company, SPJ. Correct, no? After marriage, who will do holding? Who will have control? Piyush, don't be under wrong pretext. Huh? You cannot never have control. Now holding company. Now listen. Shh. Holding company has invested 2 lakh rupees in subsidiary. Subsidiary ka share capital is 2 lakh rupees. Imagine for a second, Anita ma'am and Pratik sir not married. Both are separate. 2 lakh rupees investment Anita ma'am gave to Pratik sir. Until marriage, I have the responsibility to give this money back. If I don't give this money back, then you know what will be my condition. Yes or no? Yes. Before marriage, whatever money I took from Anita ma'am, it is my responsibility to hand over that back safe and secured. Or else, but later marriage happened. Your money, my money. My money, your money. This is balance sheet before marriage. This is balance sheet before marriage. Standalone financial statement, no marriage. Consolidated financial statement, marriage. Now tell me, people, does it look nice? That's what I'm coming to. 2 lakh rupees, 2 lakh rupees, who has to pay to whom? 2 lakh rupees, who has to pay to whom? Share capital. Share capital, who has taken the capital from? Pratik sir is taken from Anita ma'am. Pratik sir is subsidiary, Kuti Papa. Holding company, Anita ma'am. So, subsidiary company has to pay to holding. Subsidiary has to pay to holding. Any problem? Investment, who gave the money to whom? Holding gave the money to subsidiary. So we have to receive money from subsidiary. Holding gave money to subsidiary. Both were separate. When before marriage, when both were separate, one was liability, another was asset. One was liability, another was asset. We had the obligation to repay the money back. When both are one. If I give this 2 lakh rupees to Anita ma'am, it is going to come back to me only. So does it make sense saying that no, I have to give you 2 lakh? So showing liability separately, showing assets separately, does it make sense? Tell me. After marriage, Anita ma'am, me both are one. In that case, in my balance sheet, if I show I have to pay Anita so much, does it look nice? What will external world think about us? Internally, you leave it. I'm talking in the consolidation phase. Bas kya tera kya nahi. So what I did, this and this I knocked off. This and this will knock off. That is what consolidation is telling. Consolidation is telling that as long as the balance sheet was on standalone basis, Showing capital and the asset investment separately made sense. But now when you've combined it in one balance sheet, you have to give me, that doesn't hold good. You remember the amalgamation also, we had something called as, we used to cancel the contra entry. Which was the contra entry? Bills receivable, bills payable, debtor, creditor. Because I have to pay to my own self. In my balance sheet, I have debtor. In my balance sheet, I have creditor. I have to pay to my own self. Does it look nice? No. So same way, after marriage, this 2 lakh rupees I'm going to pay my own self only. This 2 lakh rupees I have to pay to whom? This fellow. Who is this fellow? My hand only. This is my hand only. Hence, we have to cancel these both. So now tell me, people, to cancel capital investment, what entry will I pass? Share capital is in the credit liability side. To cancel it, I'll give a debit. So share capital account, debit. Investment is asset having debit balance. To cancel it, I'll give a credit. So to investment. How much? 2 lakh, 2 lakh. The moment you pass the second journal entry, from the share capital, this 2 lakh will get vanished. And how much will become? 3 lakh rupees. Listen, this is a very important point. Shh. And from your balance sheet, asset side, this investment, Lakshita, will vanish. Oh my God. This is the first learning of your consolidation. Shh. When you prepare consolidated financial statement, in the consolidated financial statement, always share capital comprise of the capital of the holding company. Share capital of the subsidiary company will not travel in the CFS because it is knocked off against investment. Likewise, investment also will not appear in your balance sheet. That is knocked off against the capital. So this is the first logical explanation as to why in the consolidated financial statement, subsidiary ka capital does not come. This many people don't know. No, no. For others also will come. It's not for wholly owned subsidiary. For others also, this will come. You wait, I'll tell everything. I'll discuss. This is one point people don't know. This I tested with our students only. Okay. Yeah. Not only them, I tested multiple people. I got one call 4 days ago also. He was doing some from some other academy. For accounts, he said, I want your subject. So he called me. He's already completed. I think he's given the exam, but he's not satisfied with the performance. Actually, he inquired before itself. No, he said after exam will come. So I was actually doing that some only that time. I'm like, okay, let me ask him some question. This only I asked. Now, if somebody asks you, why does the share capital of the subsidiary company does not come to holding company? Can you justify? Because that has been knocked off with the investment. That knocked off with the investment, and never ever the subsidiary capital will reach to the capital of the consolidated financial statement. Okay, not okay. This is not that easy what you're thinking. I have given this question without masala. It's a plain question. When masala comes, that time only taste will come. Now, please tell me, will we pass any journal entry in the CFS, in the books of accounts? No, no, no. This is only for your understanding. While preparing, note also I gave for disclaimer purpose. While preparing consolidated financial statement, no journal entries are actually passed in the books of accounts. The journal entries discussed here is only for teaching purpose to facilitate the understanding of the adjustment of CFS. Okay, not okay. Sorry. Now listen. This is how you prepare the CFS based on Schedule 3. So if anybody is watching today's lecture without knowing Schedule 3, you can't manage this topic. There are certain topics that you have to complete before you come to the consolidation. Schedule 3 you have to have in your fingertips. Amalgamation you should be clear. In amalgamation, especially goodwill part. Goodwill part you have to be very, very strong. AS 18 you have to be very, very strong. These are the 3 topics, bare minimum you have to have a hold on, without which you can't manage with the topic. Now, look at the presentation. Equity and liability is the main heading. Under that, the first heading is, subheading is shareholders funds. In shareholders funds, we have how many sub-classification? 3 sub-classification. First one, share capital. Second one, reserves and surplus. Third one, money received against share warrant. Super. In that, share capital will come only of the holding company. Always, people. Always. This is true for all the questions. In the capital of the CFS, always the holding company ka capital only will come. 3 lakh. If you look here, after I eliminated the capital of subsidiary company, what is left? 3 lakh is left in the capital. Okay, not okay. Then current liability. I did not give you the breakup of current liability. So entire 8 lakh, I've taken in the current liabilities. So how do you do it? Just add these. Because of consolidation, was your current liability, current asset touched? No. Got it, not got it. Just add these both, your game is over. Just add these both, game is over. Likewise, current asset, add these both, game is over. How much? 11 lakh. Current asset, add both, 11. Share capital, current liability, current asset. Any problem? Sir, for this, are we supposed to prepare notes to accounts? Note 1, share capital. Note 2, reserves and surplus. Yes. Wherever notes are required, you have to do it. Don't be surprised. In exam, you might not get a standalone question on schedule 3. What they will do, either in amalgamation or internal reconstruction or in consolidation. They'll ask this concept also. With that, they'll check your schedule 3 ka knowledge also. Got it? So schedule 3, very important. Either you'll get a standalone question individually or they'll combine you with the consolidation. Got it, not got it. So schedule 3 is very, very important. Can I go to the next part? One masala I put. Only one masala. Gradually, there are so many masala, little by little. I've decided that I have to torture you, but not in one shot. Slowly. I should give pain, but not in one shot. Slowly. In such a way that the pain is not felt. When you go to doctor, injection, you know that, I don't know whether you've seen the reel or not. This one doctor, kids doctor. What do we call them? I don't know. Pediatrician. Oh my God. After being a father also, I don't know. Pediatrician. So there's one nice gentleman on Instagram. He will take one small needle. He will play with that baby. Potentially, he will give injection. He'll give injection. That baby will not even know that he's got one dose also. Oh my God. So I've learned that trick from magic from him. So I'll give you multiple injections and you'll not feel the pain also. Appreciate, clap hands for me. Loudly, loudly. Proper. ये देख, lazy goose. Example 2. Calculation of simple CFS with goodwill. Now, concentrate. Balance sheet of H Limited, S Limited is given on 31st March 25. Any problem? No problem. What do you observe, people? Share capital of H Limited is 3 lakh. S Limited, 2 lakh. Liability of H is 825 and S is 1 lakh. Any problem? How much is total, people? How much is total of H Limited? 11 lakh, 25,000. And for subsidiary? 3 lakh. What do you observe in the asset side? Asset, what do you observe? Sir, there's some investment, sir. 100% investment in S Limited. Who has done this investment? H is done in the S. So my question is S Limited the wholly owned subsidiary of H Limited or is it partly owned? Wholly owned.
Yes,
Wholly owned. How do you say so? Oh, 100% of capital of S Limited has been contributed by H. So S is the wholly owned subsidiary of H Limited. Super. Current asset 8 lakh and 3 lakh. Wonderful. Now tell me one thing. In the previous question, the existing shareholder holding 2 lakh worth of capital, he gave that money, he gave that share to another shareholder by name H Limited for 2 lakh only. In other words, SPJ, AJ gave 100% stake to Kalpavriksha Academy for 2 lakh. Means what money I contributed as capital, same money I got it back from the new investor. I didn't charge anything extra. This is one scenario. In second example, I am telling H Limited, why should I give the shares of this company chumma? I have invested in this company for 2 years, 3 years, 4 years. Now understand this point. Here the concept of goodwill will come. The concept of goodwill is discussed where 2 times, rather 3 times. One in your 12th. Second in foundation. Third in inter, when we did amalgamation. In inter we did not discuss that much because I told you was a recording of 12th and foundation. Now, SPJ and AJ has been investing in that company. Which company? FFLA. For how many years? 3 years. 3 years like Amul Baby have taken care of this company. From the scratch till the 3rd year, we have done so much of hard work. And the company is still profitable. Though low profit, but is profitable. Now here, I'm going to give 100% of my stake to KVA Limited. Which means from the 4th year onwards, who's going to enjoy the profit? KVA is enjoying the profit. I've sown the seed here. Now the time is to reap the fruit. So who's going to enjoy the fruit? KVA. Who has sown the seed? SPJ, AJ. That is, I have sown the seed. I've done the watering on day-to-day basis. I've run this company for 3 years. I gave my blood and sweat, everything to the company. Now, when the company's come to a good stage, Kalpavriksha has taken over and they are going to enjoy the fruits. So will I give my shares to them just like that? No. I will ask them to pay goodwill. I'll ask them to pay goodwill. This we discussed elaborately in 12th standard and foundation. We took 1.5 hours to discuss this in detail. If you still want to have a discussion on that, I'll upload that video on YouTube, or it is there if I'm not wrong. I'll share that link with all of you. Just watch that part in depth about goodwill, you'll understand. Goodwill does not mean only reputation. Goodwill does not mean only brand name. This means future profit. So goodwill will come into picture whenever we talk about sacrification of profit. Whenever we talk about sacrification of profit, what will come into picture? Goodwill will come into picture. SPJ and AJ sacrifice their shares. With that, profit also sacrificed. So here, since we are sacrificing the profit, we will not give the capital free of cost. We will charge some extra money over and above that. The extra money that I charge over and above that is called as goodwill. So here, PC. PC stands for purchase consideration. Purchase consideration. Who will pay money to whom? Holding company. That is Kalpavriksha will pay to me. Purchase consideration. Holding company will pay two amount. One towards net asset, or rather I'll say share capital. One they have to pay towards share capital, plus they have to pay towards goodwill. These both together is called as purchase consideration. Now, what is the worth of the share, people? What is the worth of the share here? The worth of the share is 2 lakh. SPGAJ both put together are holding 2 lakh worth of share, which is 100% ka share. What is the capital, people? 2 lakh. But how much money did I collect from? How much money did I collect from the holding company? That is KVA. 3,25,000. What is the difference? 1,25,000 extra we collected. This extra money that we collect over and above the worth of the business is called as goodwill. This share capital is also called as net asset. What is the meaning of net asset? Today, if I sell the asset for 3 lakh, I'll get 3 lakh. If you observe here below, I've given the language. Assume the above book value represents fair value. The above book value represents fair value. Means what? Today, if I go and sell the asset in the market, no, it will fetch me exact 3 lakh rupees. Got it, not got it? Liability is at the fair value. So 3 lakh worth of asset if I sell, how much money will I get? 3 lakh. In that 1 lakh a liability I have to pay. So what is the money left? 2 lakh. So now share capital and net asset both are equal. Hence we say the share capital is also called as net asset. Which means the worth of the business is how much? Only 2 lakh. The worth of this business is only 2 lakh. But why is the holding company, why is Kalpavriksha Academy paying extra 1,25,000? Because in these 3 years, Pratik sir, Anita ma'am have created a reputation in FFLA. Students are coming into academy just by the name. And Kalpavriksha wants that name. One classic example, Akash and Baiju. Baiju's, if I'm not wrong. Baiju's acquired Akash in 2020, if I'm not wrong. Baiju's, all of you know. B, purple color logo, all of you know. They acquired a company named Akash. Akash was specialized in coaching for NEET and JEE. NEET and JEE. Now, Byju's had two choices. One, to go establish the institute all across the place. Means they have to, search for the academy. They have to rent out the place. They have to put all the infrastructures. They have to set up the whole physical faculty team, online faculty team. So they have to do all the ground level work in every city. On the other hand, they already have an established academy by name Akash. Akash by then had the branches across multiple states. Building was already there. Infrastructure, teachers, students, everything was there. All they had to do is change the brand name. From Akash, they made Byju's Akash. Byju's in association with Akash. What is the advantage here? I didn't have to do hard work. I mean, as Byju's, I didn't have to do too much of hard work exerting to set up the premises across multiple places. I don't have to go and tell people, come and take the coaching in my center. Looking at the name Akash, people automatically came because Akash has established that goodwill. So do you think Akash, when charging money from Byju's, they would only taken the net asset ka value? No. They took goodwill ka value also. Goodwill means what? Once Akash is going to get converted to Byju's, all the profit, future profit, who's going to reap? Byju's. But the seed of that, who sown it? Akash. So Akash says that because of my hard work, you're going to enjoy fruit. No, that fruit which belongs to me, give it to me. The seed which I have sown, that seed which will give first fruit, that fruit belongs to me. After acquisition, that fruit belongs to me. After that, further fruit will come. No, that you take it. But the first fruit belongs to me. That first fruit, after absorption, after acquisition, the first fruit is called as goodwill. So goodwill will come into picture whenever we talk about sacrification of profit. So here, I, Anita ma'am, have sacrificed the future profit in favor of Kalpavriksha. So hence, to compensate that, I asked extra 1,25,000. When Byju's took over Akash, Akash was going to sacrifice the future profit. That future profit, Akash asked me today itself. That is called as goodwill. So whenever we talk about sacrification of profit, goodwill will come into picture. So now here, Kalpavriksha Academy, why did they pay extra 125? Because they knew that even by paying extra 125, we can get the benefit in future. Like how Byju's felt, even if I give 100 crore as goodwill to Akash, still I can make more money. If that was the thought process, then only Byju's purchased Akash, otherwise not purchased. So Byju's thought, no problem. Even if I give 100 crores to him, I know that from this I can make 1000 crore. Using Akash ka name, and Byju's ka strategy. Byju's was very good at strategy making. So their strategy making and Akash ka presence, both combining together, I can make how much money? 1000 crore. In that, if 100 crore, if I give as goodwill, what does it matter, man? Still, I can make how much? 900 crores. That keeping in mind, people give extra money in form of goodwill. Okay, not okay. So here also, Kalpavriksha Academy Holding Company gave extra 125 to the shareholders of S Limited, thinking that by paying this goodwill extra, we will be able to benefit from it. Hence, they paid goodwill. Okay, not okay. Online people, okay, not okay.
Yes, sir.
Now, please tell me, prepare consolidated financial statement. What do we do? Just add two data. Just add two data. Can you please tell me what entry will the holding company pass? Okay. When I'm telling you what entry they will pass, in reality, are we passing any entry? No, it's only for our understanding purpose. Can you please tell me the entry? Current asset account debit. Of which company? S Limited. Very good. How much it is? 3 lakh rupees. Okay. Then two share capital. How much it is? 2 lakhs. Very good. Two current liability. 1 lakh. After this journal entry, how does my balance sheet look like? Tell me what is the share capital of H Limited already? This is consolidated balance sheet. What is the share capital of H Limited? 3 lakh. Now you have given a further credit of how much? You given a further credit of 2 lakh here. So what is the total capital, people? 5 lakh. What is the current liability already of the holding company? 8 lakh 25. How much are you adding further? 1 lakh. 8 lakh plus 1 lakh. 8 lakh 25,000. Sorry. 8 lakh 25,000 plus 1 lakh. How much it is? 9 lakh 25,000. Current asset already of holding company is how much? 8 lakh. And subsidy is 3 lakh. 8 lakh plus 3 lakh. How much it is? 11 lakh. Okay. Investment of holding is how much? 325. Nothing of subsidiary. How much? 325. Total matching, not matching. Matching. Same problem. Out of this 5 lakh, 2 lakh I have to pay. To whom should I pay? My own self. Because this is holding the subsidiary ka balance sheet. It's balance sheet of Anita ma'am and Pratik sir together. So I have to pay Anita ma'am is as good as I'm paying my own self. Does it make sense? No. So this capital and this investment I have to knock off. So to knock this off, what is the entry going to be? So share capital is in liability side, having credit balance. To close it, I have to give a debit. So two share capital, how much people? 2 lakh. No, by, oh my God. Be very clear. Share capital is on the liability side, having credit balance. To cancel a credit balance, I have to give a debit. So share capital account, debit how much? 2 lakh. I have to cancel this against investment. Investment is on asset side, having debit balance. To cancel it, I have to give a credit. So to investment, 3,25,000. Now the thumb rule is that the total of the debit and the credit should be equal because we are following double entry system of accounting. Who has given this double entry system of accounting? Sir, look at it passively, not look at it passively. Sir, look at it passively. He has given the concept of double entry system of accounting. Now, total is matching or not matching? Sakshi, total matching, not matching? Not matching. What am I supposed to do? Where is the difference coming? Debit 125. Oh my God. This is called as goodwill. This is called as goodwill. How do you calculate this otherwise? The amount that you pay will be equal to two things: share capital plus goodwill. What is the worth of the business, people? If I sell the all assets today, I will get how much? 3 lakh. In that, if I pay 1 lakh a liability, what is the worth of the business? 2 lakh. Please understand this 3 lakh, 1 lakh, and 2 lakh, what I've taken is not the book value. It is the fair value. Here I'm assuming that fair value, book value, both are same. In future, if I've given the book value, if the book value is not equal to fair value, you have to do revaluation to get the fair value. So revaluation is one more masala. I'm not putting so much pressure on you today. What is the worth of the business, people? 3 minus 1, 2 lakh. 2 lakh worth of business, technically you should give only 2 lakh. But how much are you paying? 3.25 lakh. 3.25 lakh. Extra 1 lakh what you're paying is called as 1.25 is called as goodwill. Any money that you pay over and above the worth of the business is called as goodwill. You went to shopping. Where did you go? Tell shopping. You went to shopping. Place I will decide. Loudly tell me. Where did you go? To shopping. Where do you go for shopping? D-Mart. Oh, she thought she'll go for lifestyle. No, no. After marriage, more than lifestyle, you'll be in D-Mart only. Or Spar. Smart Bazaar. So for that practice, you'll get now from now itself. You are in D-Mart. In your trolley, you have 50,000 worth of item. Oh my God, 50,000. Yes. Because in D-Mart, everything you get, sasta. So we are very greedy. Oh, this also I want, that also I want. As if this discount is going to get vanished from your life. At the end, bill is 50,000 rupees. 50,000 ka item are there in your trolley. But you paid 60,000 extra in game. In your basket, the goods are worth 50,000. Extra 10,000 you paid in game because you are overwhelmed. Looking at the discount, you're no. Tears came out from your eyes. All the other shopkeepers charge MRP. So far, you wasted so much money on MRP. When you're looking 30 rupees worth of Maggi, I'm getting for 25 rupees. Tears came. You fell in love with DMart. So you said, DMart, from my side, I'm giving 20,000, 10,000 extra. Enjoy, bonus. How much is the worth of the item in your basket? 50,000. How much did you pay? 60. You got less, paid more. 50,000 you got, paid more. Extra 10,000 what you paid is called as goodwill. Imagine ulta scenario. You in your basket had 50,000 worth of item. Looking at so many items being purchased, DMart started getting tears in eyes. They got overwhelmed now. So they're telling you purchase so much, don't pay 50, just pay 40. 50 ka item, 50 is already discount. Top of that, 10,000 extra discount. In your basket, 50,000 ka item. How much are you paying? 40. In basket, 50,000 ka item. How much are you getting? 40. Are you paying more or less? Less. Profit or loss? Profit. That is called as capital reserve. Capital reserve. It's called capital profit. Capital profit. Okay, not okay. So if you pay more than what you get, the extra money what you pay is called as goodwill. That is loss.
In the point of view of person or demand?
जो अपने जो पे किया. In our case, we purchase. No, हमारे point of view. I'm talking about our point of view. Who paid? So here, holding company got in that purchase basket or trolley, net asset worth how much? 2 lakh. They got net asset worth 2 lakh. But how much they ended up paying in the cash counter? 325. Did they pay more or less? More. How much more? 125 more. The more that you pay is called as goodwill. If you pay less, it is called as capital reserve. Any problem? Online people, any problem? It's obvious, no. I have been holding this capital for 3 years. 2 lakh capital I've been holding for 3 years. I made good profits. I've sown the seed. Fruit is about to come, but who took over the company? Holding company took over the company. So who will get the fruit now? Holding company. That fruit ka paisa I'm asking now itself. Extra money I'm asking. And holding company gave. They are getting 2 lakh worth of business, but how much they paid? 325. So extra 125 holding company paid. So for holding company, this is goodwill. For holding company, this is goodwill. Okay, not okay. Online people, okay, not okay.
Okay, sir.
Holding company के लिए goodwill है.
Goodwill paid.
Goodwill paid. Correct. So holding company has paid a goodwill of 1,25,000. Got it, not got it. This entry I'm recording in whose books? Holding company. Got it, not got it. So this will come only in your consolidated financial statement. Will this goodwill come? Will this goodwill come in the standalone balance sheet of holding or subsidiary company? No. This is only in consolidation. So this goodwill is called as consolidation ka goodwill. We call this as consolidation ka goodwill. It will not be found in any standalone financial statement. Got it, not got it. Now, the moment I debited share capital, please understand. Shh. The moment I debited share capital from the balance sheet, this will get vanished. So what is my revised capital now? 3 lakh rupees. The moment investment I credited, my investment got vanished from the balance sheet. Investment got vanished from the balance sheet. Investment got vanished from the balance sheet. Okay, not okay. The moment you debited goodwill, the moment you debited goodwill you are creating. Goodwill you debited. There's no corresponding credit. So this has got a ledger balance of how much? 1,25,000. So goodwill will now appear. We will not take. I'll take till 230. Goodwill will appear 1,25,000 here. Any problem? Goodwill will appear here for 1,25,000. Oh my God. So in this entire consolidation, did this affect my current asset? Did this affect my current liability so far? No. Two things got affected. Share capital got affected. Here I'll always get the capital of only holding company, holding company, holding company. Subsidy ka capital is not coming. Why? Because it is knocked off against the holding ka investment. And holding ka investment is not coming here. Any difficulty? Tell me people. Online people, any difficulty?
No, sir.
Goodwill ka formula, investment minus net asset. Investment is nothing but purchase consideration. 3,25,000 you paid. How much worth of benefit you got? How much ka benefit you got? 2 lakh. So what is the extra amount you paid? 1,25,000. Any difficulty? Investment, purchase consideration is the amount paid by the holding company to the shareholders of the subsidiary company. It is not paid to subsidiary company. It is paid to the shareholders of the subsidiary company for what? Acquiring its shares. When holding company is acquiring the shares, they have to pay paisa to whom? Subsidiary company or the investors of the subsidiary company? Investors of the subsidiary company. So shareholders, this money has to be paid to the shareholders of the subsidiary company for acquiring the share. This can be at par or it can be at premium. In first case, 2 lakh capital, 2 lakh net asset. How much did you pay? Same 2 lakh. Same 2 lakh at par. In this question, 2 lakh capital, how much did you pay? 325. You paid the premium. So who got the premium ka paisa? Shareholder, not the company. So you don't think that 125 is the share premium of the company. No, no, no. Company has issued 2 lakh capital at par to the shareholder, old shareholder. Now, old shareholder has sold the shares to the new shareholder at premium. So who will enjoy the premium? New shareholder, sorry, old shareholder will enjoy the premium. Got it, not got it. So in our example, Anita ma'am, Prathik sir gave shares to Kalpavriksha. Kalpavriksha gave paisa to me directly. So that extra premium came to whom? Me. That is my profit. That is the profit that I made by selling my shares. So for Kalpavriksha, it is goodwill. For Byju's, it is goodwill. For Akash, it is profit. For SPJ, Pratik, Anita, it is profit. Got it, not got it. Understand the logic concept behind it. Don't by heart. Because in this entire topic, so many twists will come in the language, in the concept. If you try to by heart, no, you are screwed. One wrong understanding is good enough to screw the entire chapter. One wrong understanding. So this is very, very important. Each and every point that I'm mentioning, please understand, do not by heart. Note, purchase consideration is paid to the shareholder of the subsidiary company and not to the subsidiary company itself. Except if it is in case of fresh issue of share. In fresh issue of share, the company is issuing the shares to the shareholder. The money will go to whom? Company. This, unless mentioned, this is issue of share, we'll always consider that the share is being sold by old shareholder to the new shareholder. In that case, the new shareholder is paying money to the old shareholders. Got it? Not got it. Now the net asset is there. No. Share capital can be computed in two ways. This we have studied where? In 12th goodwill topic, the net asset or the capital employed can be computed two ways. One is asset side approach, second is liability side approach. Same way we have here also. In exam, most of the question they'll give based on liability side approach, but few questions could be based on asset side approach also. Net asset of the subsidiary company may be computed either by liability side approach or asset side approach based on the available information. Both the approaches will lead to the same net asset figure. So based on this questions I'll do in the upcoming class. Today I gave the note and left it. But if you want to ask, what is the net asset of this company? Can you please tell me the net asset of both the companies? I'm assuming that the book value is equal to fair value. Can you please tell me the net asset of H Limited? If I go with liability side approach, the share capital plus reserves and surplus both put together is called as net assets. This formula is a little bit more complicated, but I'm putting in simple terms. Liability side approach, share capital plus reserves and surplus will give me net asset. Or second is asset side approach. Total asset minus external liability will get net assets. Total asset is how much? 1125. From that, if I minus external liability, 1125 minus 825, what do you get? 3 lakh, which is net asset. Or share capital plus reserve and surplus. What is share capital here? 3 lakh. Reserve and surplus 0. 3 lakh. Share capital 2 lakh. Reserve and surplus 1 lakh. Current liability 1 lakh. Non-current asset 4 lakh. Current asset 1 lakh. Now, matching, not matching. 5 lakh. If I add these both, this is my net asset. 2 lakh plus 1 lakh Purvi, how much it is? 3 lakh. This is called as what approach? Liability side approach. Next is asset side approach. From total asset, if I minus external liability, I'll get net asset of 3 lakh. So 4 plus 1 is how much? 5. 5 minus 2 is how much? Same 3. So if from asset side, if I go to this, I call this as asset side approach. If you add these both directly, we call this as liability side approach. Any difficulty? Once again, ma. Investment, what I paid is more than net asset, what I got, goodwill. We paid how much in our example, people? We paid how much? Holding company paid how much? 3,25,000 worth of amount. What is the net benefit you got? 2 lakh. So how much you paid extra? 1,25,000, 1.25 lakh. Any difficulty? If it is ulta, the net asset what I got is 4 lakh and the investment that I paid is 3 lakh. I got 4 lakh worth, but I paid how much? Only 3 lakh. Have I paid more or less? Less. That is a gain or loss? Gain. That gain is called as capital profit. More specifically, it is called as capital reserve. Capital reserve is nothing but capital profit. But the ledger name, account name is capital reserve. Okay, not okay. This we are not studying for the first time. We are studying since 12th foundation. This is third time we are studying in intermediate. This is how my consolidated balance sheet looks like. Shh. Share capital of only holding company will come. Subsidiary ka capital will not come. Why? It is knocked off against investment of holding. Very good. So always can I say here, share capital of holding only will come. Yes or no? Okay. Current liability will be total of both. Subject to adjustment. Here also we can have contra transactions. Contra, what we did in amalgamation. Contra entries can come, that we have to adjust. Apart from that, as it is will come. In non-current asset, goodwill is coming. In non-current asset, land, building, plant, machinery also can come. If no revaluation, take as it is. If revaluation is done, then give the effects of revaluation. So goodwill is a new item here. Current asset, I've just copy pasted. Both the data I've together taken and copy pasted. Any problem? Any difficulty in preparing the balance sheet? Online people, tell me people. Any difficulty?
No, sir.
Now, No break. With this question, I'll wind up. Oh, you want break? Okay. We'll take a break of 6 minutes, then we'll come back and continue with example 3. Thank you, people. Yes, people, welcome back from the break. Can we start?
Yes,
No.
sir.
Piyush, like what break we had? Huh? Example 3, calculation of simple CFS and capital reserve. Will you get such questions in exam?
No.
Not at all. But this is the base for those questions, big questions. Right? Now, balance sheet of H Limited and S Limited as on 31st March 25. Share capital of H Limited 3 lakh, S Limited 2 lakh, liability 6 lakh 25,000 for H Limited and for S Limited 1 lakh. So total is 925, 3 lakh. Investment, again 100% investment in S Limited. What does it mean? Wholly owned subsidiary. Wholly owned subsidiary. Okay. Current asset 8 lakh and 3 lakh. Okay. H Limited acquired shares of S Limited on 1/4/24. So H Limited has acquired the shares from whom? From the existing shareholders of S Limited. The old shareholders of S Limited, from them they were acquired it on 1/4/24, 1 year prior. Assume the above book values represents fair value. Prepare the consolidated financial statement. Any difficulty? Now, can I do the CFS directly? Equity and liabilities. Under that, the first one is, hey, donkey fellow, shareholders funds, share capital, shareholders funds. Share capital. Actually, we are supposed to put note, and in the note we have to show all the calculation. But here, to save time, I'm doing it on the balance sheet. So what is the share capital of the holding company? Share capital of the holding company is 3 lakh rupees. Will 2 lakh get added here? No. The share capital of subsidiary company will get knocked off against the investment of the holding company. So what is my share capital? 3 lakh. Always here the share capital will be of the holding company, holding company, holding company. B. Reserves and surplus. Reserves and surplus is 0 in our example. I have not taken it. Next is non-current liability, but it is not there. So we'll go to current liabilities. Current liabilities, I didn't give you the classification. So directly the total current liability is how much? 625 of the holding company and 1 lakh of the subsidiary company. How much it is? 6,25,000 plus 1 lakh. Total how much? 7,25,000. Total, please. 1,25,000. Any difficulty? Next, number 2. Assets. Very good. Under that, the first one is non-current asset, which is not there. So I'll take current asset. Current asset, how much, people? Of the holding company, it is 8 lakh and subsidy is 3 lakh. So 8 lakh plus 3 lakh, how much it is? 11 lakh rupees. Balance sheet tallying, not tallying? Not tallying. Now, working note. Tell me, what is the journal entry that now today I'm teaching from the journal entry point of view. From next class onwards, we'll shift to a working note. We will not do journal entry. Got it? But today I'm doing a journal entry. Tell me what entry the holding company is supposed to pass to incorporate all the assets and liability in my books of accounts or holding company's books of accounts. Current asset account debit, which is how much? 3 lakh. To share capital, 2 lakh. To current liability, 1 lakh. The share capital, I have to cancel it against the investment. So share capital account debit, how much? 2 lakh. To investment, how much, people? 1,25,000. Now tell me, people, what does this 2 lakh mean? This is the worth of the business. If the business is shutting down today, I will sell all the assets. You've studied dissolution in foundation, partnership. Dissolution means what? We are closing the business. While closing the business, we sell all the assets and we prepare something called as realization account. Same thing we have done in the amalgamation also. In the old company, we prepare a realization account where we sell all the asset, recover money in cash. So how much money I'm recovering? 3 lakh. This 3 lakh and the entire money, owner take it at home? No, we have to pay to the external liability holders. So 1 lakh if I pay to external liability holders, what is the balance money left? 2 lakh. This is called as net asset of the business. After paying to external liability holders, whatever the balance worth is remaining, this is called as net asset of the business. Okay, not okay. I mean, this is the final value of the business. So I'm getting a business whose worth is 2 lakh. But how much did we pay? Only 1,25,000. Did I pay more or less? I got 2 lakh item, but I paid only 125. Did I pay more or less? Less. Have you profited or made loss? Profited. How much? 75,000 rupees. And this 75,000 will be credited to capital reserve. How much? 75,000. Got it? Got not got it. So share capital knocked off. Investment in the holding company is being knocked off. Got it? Not got it. And capital reserve is newly created. Capital reserve is newly created. Capital reserve, where does it go in the balance sheet? In reserves and surplus. Oh my God. So 75,000 will come directly here. Then it is not zero. Now tell me the revised total. 11 lakh. Matching, not matching. So here, share capital is only the capital of holding company. Reserves and surplus can get changed. Reserves and surplus can get changed. Current liability I've added as it is. Current asset I've added as it is. Any difficulty? Don't by heart. By heart will not help you. Based on the question, we have to make the answer. Okay, not okay. Online people, okay, not okay.
Okay, sir.
Holding company ka capital reserve, current liability of both the companies, current asset of both the companies. This part, I don't want to touch today because it'll take some amount of time to discuss. The next topic that we are going to discuss, I call it shortly and sweetly as AOP. This is the soul of this particular chapter. This is the soul of this chapter. If your AOP is wrong, your entire balance sheet will go wrong. And all the masala, best and best masala, top to top masala, you will get to taste in AOP. Oh my God. I've kept AOP here in the next class very simple. As we climb up the classes, as we do new classes, I'll keep on adding more and more masala to this, which will give you clarity. For each masala, one different example. For each masala, one different example. So once you understand the entire concept individually, if I put all of them together, you'll be able to crack it very easily. Got it, not got it. So tomorrow, we are meeting at the same time, 12 p.m. Till 2:30 we'll do it. AOP, we'll discuss how the AOP is prepared. We will also discuss what is the meaning of cost of control. How do we do goodwill and CR calculation without journal entry in the form of working note? Also, we'll discuss how do you calculate the minority interest in the next class itself. Yes, but at very small level, not at that big level. Very small level we'll be discussing. Okay, not okay. So a very quick recap. One more time. Not back up now. Revision. Applicability of accounting standard. AS 21 is mandatory accounting standard, which is applicable on all the entities who are required to prepare the consolidated financial statement. As on today, only companies are mandated to prepare the CFS. Who is mandating them? Companies Act 2013 under section 129, subsection 3. This section mandates only companies as of now to prepare the consolidated financial statement, which means for non-companies as of now, no compulsion. So non-companies will not prepare the CFS. If any law in future says that you also have to prepare the CFS means, then you have to prepare it following the guidelines of AS 21. So does AS 21 mandates you to prepare the CFS? No. So what does AS 21 do? It guides you. How does it guide you? It sets out the principle, which is rules and procedure, means step-by-step procedure, which is required for preparation and the presentation of the consolidated financial statement. This CFS is to be prepared by whom? Holding company, which is also called as parent company. So holding company, parent company, in their financial statement, they'll add the financial statement of subsidiaries and associate. I'm not discussing associate because I'm discussing AS 23. So here they will incorporate the financial statement of subsidiary in their holding company and prepare one combined. Combined means consolidated financial statement, so that the user can understand on the whole what is the group asset, on the whole what is the group liability, on the whole what is the group turnover, on the whole what is the group profit. So on overall basis you'll get a clarity. I have a lot more points to add here, but I'm not discussing today. At the end of the chapter, I'll discuss a lot of points as to why we are supposed to do consolidation. What is the advantage behind it? What is the logic behind it? What and how does it help? I've not discussed too much. That I'll discuss at the end of the chapter. Now here in AS21, we talk about holding and subsidiary relationship. Holding and subsidiary relationship comes only by the virtue of control. And to have control, any of the 2 points have to be satisfied. If Kalpariksh is supposed to be holding company of FFLA, between Kalpariksh and FFLA, they should be holding on subsidiary relationship, means either of the 2 points should be there. First, KV should have more than 50% investment voting right in the FFLA. Or if KV doesn't want to invest, then KV should have power to compose the governing body of FFLA, which is Board of Directors of FFLA. Means what? I should be having the power to appoint anybody as director and remove the director. Either all of them or majority of them. Okay, not okay. Out of these two, if any one I have, means I have a control. The moment I have a control, I become the holding company and the other one becomes the subsidiary company. Okay, not okay. And then we discuss that how, on the broader perspective, you prepare the consolidated financial statement. We agreed that whenever you prepare CFS, the share capital of the CFS will only have the capital of holding company, holding company, holding company. Why does subsidiary capital does not come? Because this has been knocked off against the investment of the holding company. Now, if the holding company ka investment and subsidiary ka capital both are same, 2 lakh, 2 lakh, means what? Whatever is the worth of the business, same amount you have paid. You have not paid anything more nor less. But in some questions, we saw that the worth of the business is what? 2 lakh, but you paid 325. So extra 125 you paid. That is called as goodwill. So this money is being paid by whom to whom? Holding company. That is new shareholders or prospective shareholder are going to pay to the existing or old shareholder. This extra money does not go to the company. Moreover, this investment what has been done, it is not going to the company. That money already the old shareholder gave it to the company. So now that 325 what you pay, that 325 fully goes to whom? The old shareholders. Got it, not got it. In some case, we also saw that the investment which is done is worth 2 lakh, but the benefit is 1,50,000. Benefit is 150. No, I said ulta. No. But so I'm talking about capitalism. In capitalism, what happens? You get more, pay less. You get more, pay less. So net asset, what I got is worth 2 lakh rupees. How much I paid? 1.5 lakh. Worth of the business, 2 lakh. How much I paid? Only 1.5 lakh. So extra 50,000, what I did not pay is my profit. That is called as capital profit. That is capital profit of whom? Holding company. Since it is coming in the consolidated financial statement under reserves and surplus as capital reserve. As capital reserve. Today, this is what we have studied. In this, any doubts? I will upload this document in the software. For these 3 questions, read the question without journal entry, just with the working note. Can you prepare the CFS on your own? Question and direct CFS in the format of the Schedule 3. In the Schedule 3 format, you have to prepare. Do it. I'm telling you, though I insist always that follow my revision technique religiously. Though I tell it, but I never enforce too much. But for consolidation topic, I will enforce. Whatever sums we are working out in the class, every single sum, the very same day, not even next day, very same day you have to practice. Because every question is going to come with a lot of different adjustments, a lot of masala. By the time you come to the 10th class, no, what we done in the initial classes, you will forget. If you don't want to forget, this topic alone, I'm telling you, this and branch, whatever I do, then and there, the same day, please work out. And before you come to next class, just glance and come. This much alone you do for these 2 topics alone. For others, I will not insist. But for these 2 topics alone, same day, every question has to work out. Though you have worked out in class, along with me, you will do it on your own. You will do it writing practice, full with format. With format, you will do it. Properly, you will do it. And next day morning, you have to glance and come. Only for these 2 topics. Rest, you don't do it. I don't care also. But for these 2 topics, if you want to get the whole till the end, you have to do what I'm saying. Okay, not okay. Online people, okay, not okay.
Yes, sir.
Okay, sir.
Chalo, great. So guys, let's wind up. That's all from my side for this session. I'll see all of you in the next class tomorrow morning, 12 p.m. sharp. Until then, bye-bye. See you. Take care.